Imagine your rental property, not just as an asset, but maybe as a secret weapon in your tax planning. For a lot of people, tax season feels like a bit of a burden when it comes to real estate, maybe even a drain. But what if there were like game-changing strategies that could actually reshape your whole financial outlook? Turn those potential tax headaches into powerful deductions. Today, we're doing a deep dive into the pretty intricate world of real estate rental taxes. We want to reveal some critical strategies, some things that could unlock significant hidden tax savings for you.
Yeah, that's exactly the plan. We want to help you navigate the different classifications within real estate rentals. It can get complicated. And then, arm you with the knowledge to really use those differences to your advantage, tax-wise. We'll start with the basics, of course, what counts as income, what you can deduct day to day, the essentials. But we'll quickly get into the areas that can really move the needle. Depreciation, which is huge, and the often misunderstood real estate professional status. That's a big one. And maybe most importantly, we'll unpack how the type of services you provide to your tenants can dramatically change your tax situation. It's not always obvious. It's really not just about owning the property. It's about optimizing its tax position.
Okay. And our insights today, they're coming straight from the source IRS publication 527, Residential Rental Property. That's the official guide. We're also looking at an expert analysis from the AICPA, the Accountants Institute, called The Maze of Real Estate Rentals. Seems fitting. So, our mission for you, listening in, is to give you the essential knowledge, maybe a few aha moments, so you can confidently handle your rental property taxes. Turn those potential liabilities into, well, powerful deductions that help build wealth. Let's jump right in with the basics. Rental income.
Absolutely. So rental income. It sounds simple, right? Just the monthly check, but it's not always quite like that. Let's think about Sarah. She's a new landlord, just rented out her first place. She gets the first month's rent, okay, but also the last month's rent up front. Common practice. Now, that advance rent, even though it's for way down the road, the IRS says it's taxable income in the year you get it. It doesn't matter when it's technically earned. Cash received equals income now.
Okay, that's a classic trap right there. So if Sarah gets that last month's rent on, say, December 15th, even if it's for next January, it counts for this year's taxes.
That's exactly right, tied to when you receive it. Now, what about security deposits? Almost everyone collects those. Generally, security deposits are not taxable income when you first get them. Why? Because you usually have to give them back, right? There's an obligation. They only become income if they become non-refundable, or you apply them to cover something like damages or that final month's rent. So if Sarah's tenant moves out, leaves some damage, and she keeps part of the deposit to fix it, that amount she keeps becomes income in that year.
Okay, so it's about when the money is definitively yours to keep, not just when you hold it. That makes sense. And how does that work with, like, uncollected rent? Let's say Sarah's tenant just disappears for a month, doesn't pay.
Well, that really depends on your accounting method. Most individuals, like Sarah probably, use the cash method. Under the cash method, it's simple. You only report income when you actually receive the cash. So if the tenant doesn't pay, Sarah doesn't report that missing rent as income. No cash, no income. But if you're using the accrual method, less common for individuals, maybe for bigger operations, you report income when it's earned, whether you got paid or not. So under accrual, that uncollected rent would technically be income you'd need to account for. Much different.
Right. Cash method seems way more straightforward for most landlords.
Hmm.
Okay, so that's the income side sorted. Let's flip to expenses. What are those everyday tax breaks the first line of defense landlords should definitely know about?
Okay, deductions. This is where you start getting some money back, so to speak. Your everyday deductible expenses are, well, the foundation. These are the ordinary and necessary costs for managing, conserving, or maintaining your property. And this starts from the moment it's available for rent, not just when a tenant moves in. Big category. Maintenance and repairs. Now, the key here is distinguishing these from improvements. Repairs keep the property in good shape, fixing a leak, painting a room. They're deductible now. Improvements add significant value or prolong life, like a whole new roof or HVAC system. Those get capitalized and depreciated over time. We'll talk more about depreciation later.
Got it. So Sarah replaces a break-in window repair, deductible now, installs a fancy new smart thermostat system, probably an improvement, depreciated later.
Exactly. Then you've got insurance premiums. Fire, liability, landlord insurance, all deductible. Small point, though. If you pay, say, a 3-year policy up front, you can only deduct 1/3 of that premium each year. You have to spread it out pro rata.
Good reminder for those multi-year deals. What about property taxes? That's often a big chunk of change.
General real estate taxes, yes, fully deductible. But watch out for local benefit taxes. These are charges for things that specifically boost your property's value, new streets, sewers, sidewalks, that sort of thing. Those usually aren't deductible as a current expense. Instead, you add them to your property's cost basis and you recover that cost through depreciation. You can only deduct local benefit taxes if they're specifically for maintenance, repair, or maybe interest charges tied to those benefits. It's a bit nuanced.
Huh, another detail easy to miss. Okay, mortgage interest. That's usually a big one, too.
Right. Mortgage interest on loans for your rental property is fully deductible. Straightforward enough. However, here's a catch. If you refinance that rental property and borrow more than the old loan balance, the interest on that extra cash you pulled out, if you use it for something personal, like a vacation or another investment not related to that rental, that interest is generally not deductible as a rental expense.
Ah, makes sense. You can't just use the rental property mortgage as a way to deduct personal interest. What about points? Loan origination fees. They can add up.
Points.
Okay.
Yeah, those upfront fees. Generally, for rental property loans, you can't deduct them all in the year you pay them. They're usually treated as something called original issue discount, or OID. You deduct them over the life of the loan. The first thing you figure out is if the OID, including those points, is de minimis.
De minimis, meaning like too small to worry about complex rules,
Mm, it-
below some threshold.
Exactly. It's considered de minimis if the OID is less than 1/4 of 1%, 0.00025 of the loan amount, times the number of full years in the loan term. Let's use the sources example. Carol gets a $100,000 mortgage for a rental, 30-year term, pays $1,500 in points. So you calculate $100,000 times 30 years times 0.00025.
Okay, doing the math, that's $7,500.
Right. Since Carol's $1,500 points are way less than $7,500, her OID is de minimis. And what that means is she gets choices. She can deduct the points using the complex constant yield method, or she can use a simply method like straight line. If she chooses straight line, she just deducts $50 a year for 30 years, $1,500 divided by 30. Much easier.
Okay, that's way simpler if you qualify for de minimis. But what if it's not de minimis? Say Carol paid, I don't know, $10,000 in points on that same loan.
Then she must use the constant yield method. And this is where, honestly, it gets pretty technical. You'd need the loan's yield to maturity, or YTM, usually from the lender. You multiply the issue price, loan amount minus points, by the YTM, then subtract the regular interest paid. It basically calculates a more economically accurate interest deduction each year. It's often something your tax software or tax pro handles because the calculation isn't trivial.
Right. Definitely sounds like something to flag if you have significant points. So, what if the loan ends early? Maybe Carol refinances or sells the place.
Good question. If the loan ends, say you refinance with a different lender, or you pay it off early, or foreclosure, you generally can deduct any remaining unamortized points in that final year. It accelerates the deduction. But if you refinance with the same lender, nope. Usually you just keep deducting those remaining points over the term of the new loan. Another subtle difference.
Always catches. Okay, moving beyond interest and points. What about fees for pros or travel?
Yep, you can deduct legal and professional fees, like paying your accountant to do the Schedule E, that's the rental income part of your tax return. Also, costs, other than taxes or penalties themselves, to resolve a tax issue related to your rental activity. Generally deductible.
Good to know. And driving back and forth to the property. Say Sarah lives across town.
Okay, local transportation. You can deduct the ordinary and necessary costs, like mileage, if the trip is specifically to collect rent or manage or maintain the property. However, driving between your home and the rental is usually considered commuting, which isn't deductible, unless your home office qualifies as your principal place of business for that rental activity. That's a key exception. If you use your car, the standard mileage rate for 2024 is 67 cents a mile. But, and this is critical, you need excellent records. Usually means filling out Form 4562, Part V.
Ah, so that principal place of business designation can make a big difference for local travel. What about traveling further away, like out of town for the rental?
You can deduct travel expenses away from home if the main reason, the primary purpose of the trip is rental related. Collecting income, managing, maintenance, that sort of thing. But you have to allocate. If Sarah goes to a landlord conference but spends half the time sightseeing, only the conference-related costs, travel, lodging, meals for that part, are deductible rental expenses. Clear allocation is key.
Makes sense. Got to keep business and personal separate. What about costs before you even have a tenant, like getting the place ready?
Those pre-rental expenses, if they're ordinary and necessary for managing or maintaining the property, become deductible from the moment you make the property available for rent. So once it's listed, ready to go, even if it's empty for a bit, You can start deducting those ongoing costs like utilities, insurance, even appreciation from that point. You don't have to wait for the first rent check.
That's helpful for cash flow when starting out. One last quick one before depreciation. Renting equipment for the rental, like a floor sander.
Sure, you can deduct rent paid for equipment or property used for your rental. Just be a little careful. Sometimes a long-term lease might look more like a purchase to the IRS. If it's really a disguised purchase, you'd capitalize and depreciate the item, not deduct rent payments. Look at the substance, not just the name.
Okay, wow. Lots of nuances, even in the basic deductions. It really shows how much there is to know. Let's shift now to a really big one. Depreciation. This feels like where significant tax savings can happen.
Oh, absolutely. Depreciation is, well, it's fundamental. It's how you recover the cost of your investment property over its useful life, accounting for wear and tear. What can you depreciate? Buildings, furniture, appliances, equipment used in the rental. What you can't depreciate is the land. Land doesn't wear out, in theory. So when Sarah buys that property, she absolutely must split the purchase price between the land and the building. Only the building part gets depreciated.
Right, so when does depreciation actually start? And when does it stop? What if Sarah converts her own home into a rental? That seems common.
Depreciation begins when you place the property in service. That means it's ready and available for rent. Doesn't need a tenant yet, just ready to go. It ends when you've recovered your cost basis or when you take it out of service, sell it, convert it back to personal use, abandon it, whatever. If Sarah converts her home, depreciation starts on the date of conversion, the date she makes it available for rent. And here's something interesting. Even if the property is temporarily vacant, say between tenants while she's fixing it up, you keep claiming depreciation. It's still considered in service for the rental activity.
Oh, that's good to know. You don't lose the deduction during vacancies. What's the main method for calculating depreciation these days?
For property placed in service after 1986, which is most property now, you'll use the Modified Accelerated Cost Recovery System, or MFAERS. That's the standard.
And the basis for depreciation, is that just what I paid?
Usually it starts with your adjusted basis when you place it in service. That's typically your original cost, plus certain settlement fees or closing costs, plus the cost of any major improvements made before placing it in service. And like we said, if you buy land and building together, you have to allocate that cost. You can use the fair market values, or often people use the property tax assessment ratio to split the purchase price.
Okay, so if Sarah bought a place for $200,000 and the tax assessment says the building is worth, say, 80% of the total assessed value and the land 20%.
Yep, she'd allocate 80% of her $200,000 purchase price, so $160,000, as the depreciable basis for the building. The other $40,000 is the non-depreciable land basis. Any major improvements made after it's a rental new roof, kitchen remodel are generally treated as separate assets, capitalized and depreciated based on when they were placed in service.
And can your basis go down?
Yes. Things that are considered a return of your costs reduce your basis, like insurance payouts for casualty damage, certain energy credits you might claim, or if you took a Section 179 deduction.
I've heard a lot about bonus depreciation or a special depreciation allowance. Is that still a thing for rentals in 2024?
Yes, for some qualified property, including certain types of residential rental property components or improvements, there might still be a special depreciation allowance, sometimes called bonus depreciation, available in 2024. It's basically an extra upfront depreciation deduction you can take in the first year. It's been phasing down, but it can still be a very powerful way to accelerate deductions and reduce your current tax bill. Definitely something to look into.
Sounds like a big potential boost right away.
Yeah.
Are there different flavors of MCRS systems within it?
Yeah, there are two main systems under MCRS. The General Depreciation System, GDS, which is the default and most common. Then there's the Alternative Depreciation System, ADS. If you choose ADS, you have to use the straight line method over a longer recovery period. So smaller deductions each year, but spread out longer. For residential rentals, choosing ADS is property by property, but once you choose it for a specific property, you're stuck with it. It's irrevocable. Might make sense in certain situations, maybe if you expect higher income later.
So a strategic choice with long-term implications. Okay, what about conventions? Sounds like timing rules.
Exactly. Conventions determine how much depreciation you get in the year you start using the property, place it in service, and the year you stop, dispose of it. For the building itself, residential rental property always uses the mid-month convention. Treats the property as starting or stopping halfway through the month, no matter the actual day.
Okay, mid-month for the building. But I think there's another one, mid-quarter. When does that apply?
Ah, yes, the mid-quarter convention. This applies to your personal property, things like appliances, furniture, maybe carpeting, not the building itself. It kicks in if more than 40% of the total basis of all that personal property you placed in service during the entire year was placed in service in the last 3 months. Octo Novarded. If that happens, you have to use the mid-quarter convention for all the personal property you placed in service that year.
Whoa, wait, so if Sarah buys a fridge in October, and that fridge costs more than 40% of everything else she bought that year, like a dishwasher in January,
Yeah.
it changes the first year depreciation for the dishwasher too.
Precisely. It treats everything as placed in service midway through the quarter it was actually purchased. So that dishwasher bought in January gets treated as placed in service mid-February, middle of Q1. And the fridge bought in October gets treated as placed in service mid-November, middle of Q4. It can reduce your first year depreciation compared to the default half-year convention, which normally applies if neither mid-month nor mid-quarter applies. It's a trap people fall into if they do a lot of year-end purchasing.
Good to know. So the default is half year if none of those apply.
Hmm.
And you use IRS tables for the percentages.
Yeah, usually you look up the percentage in the IRS tables for the property type, like 5-year for appliances, 27.5-year for residential buildings under GDS, and the convention that applies, and multiply that by your unadjusted basis. The key is timing matters, especially with that mid-quarter rule.
Man, okay. That's a lot just on depreciation and basic deductions. Really drives home the complexity.
Yeah.
Let's move into something super common. Using a property personally and for rental. Vacation homes are the classic example, right? Or Sarah letting families stay sometimes.
Exactly. This is the personal use of dwelling unit minefield. First, what's the dwelling unit? It's broad. House, apartment, condo, mobile home, even a boat if it has basic living facilities, sleeping space, toilet, cooking. What it doesn't include is property used only as a hotel or motel, meaning it's regularly available for paying guests, and the owner doesn't use it as a home during the year.
Okay, so if Sarah has a separate studio apartment, she only rents out short-term, never stays there herself, maybe these specific personal use rules don't apply quite the same way.
Correct. It might be treated more like a pure business activity in that specific context. But if you do have personal use of a dwelling unit, you must divide your expenses. Your deductible rental expenses get limited based on a ratio. Days rented at a fair price divided by the total days the unit was used. Rental days plus personal days.
Okay, fair rental price seems important there. What is that? Can Sarah just charge her brother half price for a week?
No, fair rental price is what an unrelated person would typically pay for a similar property, same size, condition, location, etc. Renting to family or friends at a discount or for free. Those days usually count as personal use days, not rental days for this calculation.
Ah, so charging less than market rate makes it personal use. Let's use that beach cottage example. Rented 85 days at fair price. Owner used it 14 days personally in May, and then stayed 2 days during a rental period without reducing rent.
Okay, let's break it down. Rental days at fair price, 85. Personal use days, 14 in May, plus those 2 days during the rental period count as personal for the used as a home test. So total personal use is 16 days, total days used, 85 rental plus 16 personal equals 101 days. So the rental expense deduction is limited to 85,101, which is about 84% of the allocable expenses. The other 16% related to personal use isn't deductible as a rental expense.
Wow, that cuts into the deductions significantly.
Yeah.
And there's a threshold where it's officially considered used as a home, right?
Yeah.
Which has even bigger consequences.
Yes. It's considered used as a home if your personal use days exceed the greater of 14 days or are 10% of the days it was actually rented at a fair rental price. If you cross that line, your rental expense deductions, beyond things like mortgage interest and property taxes, which are deductible anyway, subject to limits, generally can't exceed your rental income. You can't create a loss to offset other income if it's deemed used as a home.
Okay, so what exactly counts as a day of personal use? It sounds like it's more than just you being there.
It is. It's any day used by you or any co-owner. Used by a family member, unless they pay fair rent and it's their main home. Used by anyone under a house swapping deal. Or used by anyone paying less than fair rent. All those count as your personal use days.
So if Sarah lets her parents stay for free for a week, even if Sarah's not there, those are her personal use days.
Yep. It's about the owner's connection or benefit. Even if Sarah rents to her brother at half price, those are personal use days for her.
Is there any way out? Like, what if the owner is there working on the place?
Yes, this is important. Any day you spend working substantially full-time on repairs and maintenance, actual work, not just overseeing or planning improvements, does not count as a personal use day. This holds true even if your family is there enjoying the property recreationally while you work. So if Corey spends a week at his cabin fixing things for 6 to 8 hours a day while his family hangs out, those aren't counted as his personal use days. It recognizes the landlord's effort.
That's a great exception for hands-on owners. What about converting your main home to a rental or back? Did that mess up the personal use count?
There's a special rule. Days you use the property as your main home before you started renting it or after you stopped might not count towards that used as a home test, the 14-day 10% rule. This applies if you rent it out, or try to, for 12 consecutive months or more, or if you rent it for less than 12 months but the rental period ends because you sell the property. It prevents your prior personal living time from immediately triggering the deduction limits when you convert it.
Okay, lots of rules just for mixing personal and rental use. Really need good records of usage days. What about unique situations like condos or co-ops?
Good question. Condos. You can deduct your regular HOA dues or assessments for common area maintenance, but special assessments for big improvements, new roof for the whole building, paving the parking lot, those usually get added to your basis and depreciated, not deducted immediately. Cooperatives are different. You own stock, not the unit. You deduct your maintenance fees paid to the co-op. For depreciation, it's weirdly complex. You have to figure depreciation on the co-op corporation's entire building, allocate it based on your stock percentage, and it's limited by your basis in the stock. Definitely one to get professional help with.
Wow, yeah, co-op depreciation sounds tricky.
Right.
Okay, what if Sarah converts her old primary home into a rental? How does she figure the depreciation basis?
When converting personal property to rental use, the basis for depreciation is the lower of two numbers. Your adjusted basis in the property on the conversion date, or R, the fair market value, FMV, on that same date. So if Sarah's house cost her $150K, plus improvements, maybe adjusted basis is $170K, but on the day she converts it, its FMV is only $150K. She has to use the lower $150K as her starting point for depreciation. Prevents deducting declines in value that happen during personal use.
And if you rent just part of your property, like a duplex, live in one side, rent the other.
You have to divide expenses. If it's 50-50, use like a duplex. You allocate shared expenses like the mortgage interest, property taxes, insurance, utilities. 50% goes on Schedule E as rental expense. The other 50% relates to your personal use. You might be able to deduct some of that, like mortgage interest and taxes, on Schedule A if you itemize, subject to the usual limitations.
Fair allocation is key. Last basic scenario. What if you're not really renting for profit? The hobby loss rules. Sounds bad.
It can be. If the IRS decides your rental activity isn't engaged in for profit, maybe you consistently have large losses year after year with no realistic prospect of profit, or you charge minimal rent, they can classify it as a hobby. If that happens, you still report the income, but your expense deductions are generally limited to the amount of that income. You can't use hobby losses to offset your other income. There's a presumption you are for profit if you actually make a profit in 3 out of 5 consecutive years. You can file Form 5213 to postpone the determination if you're starting out. But yeah, avoiding the hobby loss classification is crucial if you expect losses initially.
Okay, we've covered a ton of ground on the fundamentals. Now let's get into the advanced strategies. This is where things like the passive activity rules and the real estate professional status come in, the stuff that can really impact your bottom line.
Right. This is where the tax code can either be a major obstacle or offer significant opportunities. Let's start with the big hurdle, the passive activity rules. By default, the law says rental real estate activities are automatically passive, just by definition. What that means is, if your rental property generates a loss for the year, expenses exceed income, you generally cannot use that loss to offset your non-passive income. Non-passive income is things like your salary from a job or income from a business you actively run, or portfolio income like stock dividends and interest. So those rental losses get suspended. They don't disappear. You carry them forward to offset future passive income or deduct them when you eventually sell the property. But you don't get the immediate tax break against your regular income.
So Sarah has a $10,000 loss on her rental, but makes $100,000 at her job. She can't just reduce her taxable income to $90,000 because of the rental loss.
Not automatically, no. That $10,000 loss is generally stuck in the passive bucket. Now, there are some nuances like recharacterization rules. For instance, renting out land, mostly non-depreciable property, might generate non-passive income if profitable, but still passive losses if not. It's complicated. And there's the self-rental rule. If you rent property to your own business that you materially participate in, the income is treated as non-passive, which can actually be good, helps avoid the net investment income tax. But losses might still be passive.
Okay, so passive is the default, and it limits losses. But isn't there a big exception, that $25,000 allowance thing?
Yes. That's the special allowance for rental real estate activities. It's a major exception. If you actively participate in your rental activity, you might be able to deduct up to $25,000 of those passive rental losses against your non-passive income. Active participation is a lower standard than material participation. It means you're involved in management decisions, approving tenants, setting rent, approving repairs, even if you hire a property manager. You just need to be making the key decisions. You generally need at least a 10% ownership interest too.
Okay, so active participation unlocks up to 25K in losses against other income. That sounds great. Is there a catch?
There is. It phases out based on your income. If your modified adjusted gross income, MGI, is $100,000 or less, you get the full $25,000 allowance potential. But between $100,000 and $150,000 MHI, the allowance is reduced by 50 cents for every dollar your MVI is over $100,000. So by the time your MDGI hits $150,000, the special allowance is completely gone. Poof! No 25K deduction against your regular income if you earn too much.
So that $25,000 benefit disappears entirely for higher earners, making those passive loss limitations even tougher. Is there ever a time you don't have to file that complex Form 8582 for passive losses?
Yes, sometimes. If all your passive activities are rental real estate where you actively participate and your total net loss is $25,000 or less and your MAGI is $100,000 or less and you have no prior suspended losses or passive credits, then you might be able to skip Form 8582. But if any of those aren't true, you likely need to file it.
Okay, now for the big one. The strategy that gets talked about a lot for serious investors, qualifying as a real estate professional. This sounds like the way to completely bypass those passive loss limits.
It is. This is the potential holy grail for unlocking rental losses. If you qualify as a real estate professional for tax purposes, your rental activities are not automatically treated as passive. Now, qualifying isn't enough by itself. You then also have to prove you materially participate in those rental activities. We'll get to that. But if you meet both hurdles, real estate pro status and material participation in the rentals, then guess what? Your rental losses become non-passive. That means they can offset any other income you have, your high salary, your spouse's income, business income, investment income, everything.
Yeah.
This can lead to massive tax savings, turning large paper losses from depreciation into real cash savings.
Okay, that sounds incredibly powerful. Being non-passive is the goal. So what are the hoops you have to jump through? The tests to qualify as a real estate professional.
There are two specific, strict tests, and you absolutely must meet both of them each year. Test 1, the more than half services test. More than half of all the personal services you perform in all your jobs or businesses during the year must be in real property trades or businesses where you materially participate. Real estate has to be your main gig, time-wise. Test 2, the 750 hours test. You must spend more than 750 hours during the year performing services in real property trades or businesses where you materially participate.
Wow. So 750 hours, it has to be more than half your total work time across everything you do. That's a serious commitment. What counts as a real property trade or business?
It's defined pretty broadly. Development, construction, acquisition, conversion, rental, operation, management, leasing, or brokerage of real property. So being a realtor, a developer, a property manager, or even a very active landlord managing your own portfolio could qualify, provided you meet the time tests.
And you mentioned material participation is still required after you qualify as a real estate professional. What does that involve? It sounds like another layer.
It is. Qualifying as a real estate pro gets your rentals out of the automatic passive category. But to make the losses non-passive, you still need to show you materially participated in the rental activity itself. Material participation has its own set of tests, mostly based on hours. The most common ones are working more than 500 hours in the activity during the year, or if your participation was substantially all the participation in the activity, or working more than 100 hours, and that's more than anyone else worked. The hours spent qualifying as a real estate professional, like brokerage work, don't automatically count towards material participation in your rentals. You need to track time spent on the rentals specifically.
So it's a two-step process. Qualify as a pro overall, then materially participate in the specific rental activities. But you mentioned spouses. How does that work?
Ah, yes. Very important point for married couples filing jointly. Your spouse's hours spent participating in an activity can be counted towards your material participation hours for that activity. So if one spouse qualifies as the real estate professional based on their own work, meeting the 750 hours halftime test, the other spouse's hours spent managing the rental properties can help meet the material participation test for those rentals, making the losses non-passive for the couple. It's a huge planning opportunity.
That is huge. One spouse's professional status plus the other's management time can unlock those non-passive losses. Okay, so real estate professional status is the key to potentially deducting unlimited rental losses against other income. What about just being considered a trade or business? You mentioned that unlocks other things.
Exactly. This is another important classification, separate from the passive activity rules and real estate pro status. Why does it matter? Because if your rental activity qualifies as a trade or business under Section 162 of the tax code, it potentially opens the door for two very valuable deductions. The qualified business income, QBI deduction, also known as Section 199A, and the Section 179 expensing election.
QBI, that's the one that lets you deduct up to 20% of your qualified business income. That sounds very worthwhile for a profitable rental.
It absolutely is. Getting a 20% deduction on your net rental income is a significant tax break, but it's only available if the rental activity rises to the level of a trade or business. How do you meet that standard? It's generally a lower bar than material participation. The IRS looks for regular and continuous activity by the taxpayer or their agent in relation to the property. And interestingly, the IRS guidance suggests even owning and managing a single rental property can qualify as a trade or business for QBI purposes, provided your involvement is regular and continuous. It's more about the scope and nature of your management activities than just hitting a specific hour count.
So less about the 500 hours like material participation, more about consistent management effort. And this is different from the passive activity definition.
Explicitly different, yes. You could have a rental that is a trade or business for QBI purposes, but still be passive for the loss limitation rules because you don't meet one of the material participation tests. The definitions operate independently for different code sections. This trade or business status is also required if you want to use Section 179 expensing. That lets you immediately deduct the full cost of certain qualifying property like appliances, furniture, maybe even a new roof under specific recent rules instead of depreciating it over many years. Section 179 requires an active trade or business. For non-corporate lessors, most individuals, there are extra hurdles too, related to the lease term and the amount of non-interest tax depreciation expenses you incur. But if you qualify, it's a powerful way to deduct capital expenditures immediately.
Okay, so multiple layers of activity definitions leading to different benefits. Active participation for the 25K allowance, real estate pro plus material participation for unlimited non-passive losses, and trade or business for QBI in Section 179. Keeping them straight is key. Now let's tackle another area of confusion. How the services you provide affect things, especially this idea of commercial versus residential in the tax world.
Right. This is crucial, particularly when it comes to self-employment tax. People hear business and think self-employment tax, but for typical real estate rentals, that's usually not the case. The general rule is income from renting real estate is not subject to self-employment tax. Social Security and Medicare taxes for the self-employed, about 15.3%. That's a huge benefit.
So Sarah just collecting rent from her apartment building, probably no SE tax on that net income.
Typically, no, but there's a major exception. If you provide significant services to the occupants, services that are primarily for their convenience and go beyond what's usual or customary for just renting space, then the activity is not considered rental from real estate for SE tax purposes, and the net income will be subject to self-employment tax.
Okay, significant services. That sounds like the dividing line. What does the IRS consider significant versus just normal landlord stuff?
Think hotels versus apartment buildings. Significant services are things like maid service, cleaning the inside of the units regularly, changing linens, providing meals, concierge services, things primarily for the occupant's convenience, not just maintaining the property itself.
So stuff you'd expect at a hotel or maybe a high-end serviced apartment.
Exactly. Those would likely trigger self-employment tax. What's not generally considered significant, providing heat and light, cleaning common areas like lobbies and hallways, collecting trash, handling maintenance requests like fixing a leaky faucet, providing basic amenities like laundry rooms or a pool without extra services like an attendant or laundry service. Those are considered customary for basic occupancy.
So operating a standard apartment building, even with nice common areas, probably doesn't cross the line into significant services territory for SE tax.
Generally not. It's about the personal services rendered directly to the occupants. So running a hotel or a bed and breakfast, likely subject to SE tax. Running a typical long-term rental property, likely not. This distinction is based purely on the level of service, not whether the building is zoned commercial or residential.
That's a critical takeaway. It's the service level, not the property type. Does this service distinction matter for anything else, like S corporations?
Yes, it does. An S corporation can face an extra tax on passive investment income if it has prior C corp earnings and profits and too much passive income, like rents. But the rules say rents are not passive for this purpose if they're derived in an active trade or business of renting property. And how do you prove that? By showing the S corp provided significant services or incurred substantial costs in the rental business. So again, that level of service helps classify the income as non-passive, avoiding a potential extra tax for the S corp.
So the bottom line here seems to be, the tax treatment really hinges on the nature and extent of the services you provide, not just the label on the building. This determines if it's seen as a passive investment or an active business for various tax purposes.
Precisely. That distinction impacts self-employment tax, QBI eligibility, since providing significant services certainly implies a trade or business. Section 179, and even S corp taxes. It's a fundamental differentiator in the tax code's eyes.
This has been incredibly insightful. So many interconnected rules. Let's try to wrap our heads around the big picture, putting it all together for a smart strategy.
Okay, the holistic view. First, understand how becoming a real estate professional and materially participating can potentially free you from the passive loss limits. That's huge. It allows those paper losses, often driven by depreciation, to directly reduce your overall taxable income from any source.
And then layer on top of that the trade or business classification. Even if you're not a real estate pro, or even if you are, but your income isn't subject to SE tax because you don't provide significant services, establishing that trade or business status can unlock QBI and Section 179, more deductions.
Absolutely. It's about understanding which key fits which lock. And the master key to all of this working, meticulous record keeping. You need records for income, every single expense, the allocation between personal and rental use, and crucially, if you're aiming for real estate pro status or trying to prove material participation, you need contemporaneous logs or calendars detailing the hours you spent, what you did, and when. You have to be able to substantiate your claims.
So what are the main takeaways, maybe the big aha moments for someone listening who owns rental property or is thinking about it?
I think the biggest one is that it's not just about owning the property, it's profoundly about how you operate it and how you document that operation. That's what drives the tax outcomes. Second, the IRS definitely scrutinizes rental activities, especially large loss claims against other income. Understanding the rules and classifying things correctly before you file is your best protection, and also your best way to maximize legitimate savings.
And for me, the big aha is realizing that words like passive, active participation, material participation, trade or business, significant services, they aren't just general terms. They have very specific, distinct legal meanings in different parts of the tax code, each opening or closing different doors for deductions and tax treatment.
That's perfectly put. The system is designed to differentiate, and understanding those differences is where the optimization happens.
Okay, so to quickly recap, we've gone from basic income and deductions through the power of depreciation, navigated the complexities of personal use, and dive deep into passive activities, the game-changing real estate professional status, the importance of being a trade or business, and how service levels dictate tax treatment. Hopefully you've got a much clearer roadmap now.
We really hope so. And maybe here's a final thought to leave you with. Could really focusing on tracking your activities, not just dollars, but your time, the nature of your engagement, the services you actually provide, could that fundamentally change how you view your properties? Could it transform them from just assets into, well, powerful engines for optimizing your entire tax picture?
That's a great question to ponder. We definitely encourage you to look at your own rental situation through these lenses. Are you tracking enough? Could you qualify as a real estate professional? What level of service are you really providing? This deep dive is hopefully just the start of you becoming an even savvier, more informed real estate investor.